Good morning. My name is Chris Akers, and as Irv said, I work with him at the Department of Local Affairs. I've been there for just over a year, so last year Kirby asked me if I would come and talk, and I said, Kirby, I'm just trying to figure out where the bathroom is at the office and a lot of other important things, so not quite ready, but he wouldn't let me off the hook this year. So it's my pleasure to be here and to address this group. I'm going to cover a lot of the same information that Jason did, but hopefully it will all be complementary, and we can kind of delve into a few different aspects of what he covered. And one of the things that I'm going to look at as well is going to be kind of starting off as with a global overview and kind of get a better feel for what the emerging markets are doing and what kind of the demand is going to look like on an aggregate at a global perspective using some International Monetary Fund information that was just released last week. Then I'm going to kind of look at the employment situation in the U.S. and Colorado. And as Jason mentioned in his presentation, that energy producing states, Colorado included in that bunch, really performed significantly better than the nation did coming out of the Great Recession. And we'll see that in a couple of the slides that I have. One of the themes that our office really likes to drive home is how employment changes drive population changes. Jason mentioned that kind of in regard to the last question, whereas if the jobs aren't there, people are going to move to where the jobs are, and that kind of affects the labor force and availability of labor as well. But it really is kind of the natural way of the market to reach equilibrium and hopefully help to bring down unemployment rates in places where they're high by having the labor force move to places where the jobs are a lot more plentiful. I'm going to look at mining changes in both nationally, kind of looking from the Great Recession to current, and contrast what Colorado looks like compared to the nation as well. We'll see a very similar trend, but Colorado just a little bit more extreme in some of the movements that we have. And then finally, I'll give some of the numbers behind the index production that Jason showed, where Colorado has definitely outperformed the nation in terms of how our oil and gas production has occurred. Mostly it's on the oil production front over the last 5 years. And then finally, going to kind of talk about how some of the employment has shifted across the state and really kind of moved from the western slope to the Front Range area as the drilling has focused more in the Weld County area and on the Niobrara oil shale play there. And then finally, I'll kick it over to Irv, and he'll talk a little bit more about the direct distribution and energy impact grants, as I know that's something that's very much of interest to a lot of the audience in the room. So what the IMF had to say was that the global recovery is going at a slowing pace and is very fragile. I think it's kind of ironic that we could probably use that to talk about the state of oil and gas here in Colorado, slowing down, and that it's kind of fragile and very volatile as well. One of the reasons why the global economy is slowing and is more fragile is those emerging markets that Jason had mentioned. China really sent some shockwaves through the global economy last year in August when they devalued their currency to try to make their exports a little bit more competitive. And they're really in a tough position right now where they're trying to move from an export-oriented economy that really allowed their economy to grow very robustly over the past few decades to one that is more consumer-driven, very similar to what the United States is now. One of the themes that we've seen across commodity exporting countries is that there's been a great amount of weakness, with commodities down roughly about a third in 2015. A lot of these countries have really suffered there, and a lot of them are kind of in recessions right now. If we look at Canada, Russia, Brazil, all really been impacted adversely by the falling commodity prices. Low oil prices have led to destabilized outlook for oil exporters. One only need to look down to Venezuela for a poster child of how destabilized it could be with their rampant inflation and just general social unrest and problems that they're having there due to the fall in oil prices and how much of their country's economy is reliant upon exporting crude to the world market there. And with the lower prices that they're receiving, it's really hurting their overall outlook there. Finally, large emerging markets such as Brazil and Russia are mired in deep recessions right now. I think it's safe to say that the BRICS have cracked, and the BRICS are Brazil, Russia, India, and China. And if we look at some of the weakness and slowing growth that China has faced, coupled with deep recessions in Brazil and Russia, that really is kind of evident as to why the global demand has slowed down and why we do have a kind of a glut of oil right now and lower oil prices that we're facing across the world. The kind of silver lining on this is that advanced economies are really carrying the mantle of growth. These advanced economies namely would be the United States, Germany, and the United Kingdom. All these countries that are typically importers of oil are really benefiting from the lower oil prices, and it's helping to support domestic demand. I'll get to that a little bit more later there. But at the same time, our growth has been constrained a little bit by the weak external demand. Our goods and services that we produce here are exported nationally or internationally, and if a lot of these emerging markets are slowing down, there's less demand for our products, and that's kind of hampering us. At the same time, we've also seen a lot of exchange rate appreciation. So the dollar has grown stronger, which makes our products more expensive on the international market and has really kind of hurt our manufacturers to a certain degree, as they're less competitive as the dollar has appreciated. As Jason mentioned, Colorado really was in a group of oil-producing states that did fantastically well coming out of the Great Recession. The U.S. is up about 5.3 million jobs from where we were in January of 2008. That was the peak of employment before we endured a large employment decline for about 2 years. So about 3.9 or 4% more jobs than what we had at the time of our previous employment peak. In Colorado, we were the 5th fastest growing state in the nation and added the 5th most amount of jobs. And what's impressive, if you look at a lot of the other states that are up there that added more jobs than us, those are all the largest states in the nation: Texas, California, New York, and Florida. In percentage growth terms, we were only behind North Dakota and Texas significantly. Both of them were really buoyed by the kind of explosion of drilling and higher oil and gas prices there, but that has kind of changed, and North Dakota definitely is not doing as well as they were before, and Texas is even showing some slowing too. Unfortunately, a lot of the growth that Colorado has enjoyed has been disproportionately concentrated in the Front Range, up and down the I-25 corridor and a little bit out I-70 east and west there. So I'll touch on that at the very end of my presentation as well. But as I mentioned before, we really like to say how population follows the jobs. And if we look at these 5 states here, that they accounted for about 2/3 of the total job growth that occurred in the United States. So there was a point in time when Texas made some claims that they were responsible for all the jobs that were recovered here in the United States, and I think that's kind of very typical of Texas right there. I'm not going to say big hat, no cattle, but they're very boastful out there for sure. Everything is bigger and better in Texas, as we all know there. So to look at population changes, the U.S. population has grown by about 4% from 2010, the census period, to 2015. That's the addition of just under 13 million people who have moved to or who are now here in the United States. Our total population in the United States is about 323 million now. Colorado was the 3rd fastest growing state, and we added the 8th most amount of people in absolute terms over this period from 2010 to 2015. Our total population growth is really impressive when you look at we added about 10,000 more people than New York added over this period of time. And if we look at it in percentage terms, North Dakota did better than us, and Texas did as well. North Dakota and Washington, D.C. also benefit from that slightly smaller base, so that makes their percentage growth more impressive. If we just zoom in on what happened in 2015, 2015 was an incredible year of population growth for Colorado. We added more than 100,000 people. 101,000 was what our population growth was. That's 1.9% population growth. Just to put that into perspective, the nation grew by 10 0.8 percentage point. So we were growing by more than twice as fast, our population, than what the nation was. In terms of percentage, at 1.9%, only North Dakota grew faster than we did, but I don't think that there's a lot of people flocking to Williston, North Dakota anymore and filling up those Walmart parking lots looking for jobs there. If they are, they're probably taking their RV and heading in the opposite direction here. So this is what the big picture for the employment looks like in the United States. So January 2008, we reached our employment peak. We then lost 8.7 million jobs through February of 2010. That's about a 6% decline. Since then, we've added 14 million jobs, so that takes us from that trough, and we're now about 4% above where we were in 2008. Now, to make things even more impressive, I'll put Colorado on here, and we'll see that we were a little bit slower going into the recession. We lost almost same percentage of our workforce as what the nation did, but our rebound has been much more spectacular than the nation. So we lost about 145,000 jobs and have since recovered about 375,000 jobs to put us at that plus 235,000 roughly from our previous peak. So our growth has been very impressive. Oil and gas has definitely helped to contribute to some of that growth, but as Jason mentioned, we are much more diverse than what we were in the 80s and than what a lot of other oil producing states are. If we look at some other states that are very oil dependent there, namely Alaska, Oklahoma, Louisiana, a lot of those states are now in Wyoming included in there in negative over the year growth in jobs. They actually have fewer jobs now in March than they did in March of 2015. And then West Virginia also falls into that camp too, but that's more on the coal front than on the oil and gas front there. So nationally, the lower oil and gas prices have really helped the U.S. Employment growth in the United States was just under 3 million. If it weren't for the loss of oil and gas jobs, we would have added probably about 3 million jobs in the United States in 2015. That's an increase of 2.1% from the previous year, which marks our fastest growth since 2000 when we added 2.2. So, if you look at where we are almost back to where we were kind of in the end of the roaring 90s and the dot-com boom that was going on there, and that's a real positive there. One of the things that has helped make the growth a little bit stronger is lower oil and gas prices have had the effect of giving every household essentially about $1,000 more that they have in their pockets to spend than when they just were back in 2014. So the bulk of this is less money that's being spent at the pump, but there is also some savings that we're also seeing from our heating bills. And with the lower natural gas prices that we're seeing now, the Energy Information Administration actually projects that 2016 will see lower heating bills and utility bills across the United States right there, which will only further help to boost the amount of money that we have to spend as consumers, and will also help to keep down our inflation rate too. So in real terms, we'll actually see some positive wage gains overall. Now we're going to look at specifically the mining employment in the United States. This is very similar to the previous chart that I showed you. You do see where mining continued to grow a little bit. Mining employment continued to grow as the rest of the nation was losing jobs, but that changed pretty rapidly when the price of oil fell significantly, and we lost a considerable amount of mining jobs through about October of 2009. However, from October of 2009 through the late 2014, the nation added about 250,000 mining jobs. Unfortunately, you can see, and this is something that Jason showed too, that we've lost a considerable amount of jobs over the last 15 months, about 180,000 jobs. And so nationally, we're a little bit lower in terms of our total mining jobs than we were in January of 2008. Now, Colorado, I'll put them on here now. We see that we follow a very similar trend to what the nation did, although we're a little bit bit more exaggerated. We grew a little bit more in the late 2008 period there, lost a little bit more, had a little bit deeper decline, but our rally has been very impressive, going right up until the fall of 2014. And then unfortunately, we've lost a lot of employment, just like the nation, similar trend that we followed. So Colorado, from that trough in late 2009, was up about 13,300 mining jobs. We've since lost about 9,500 of them through March of this year. And as Jason mentioned before, the driving force behind this all is really the oil and gas prices that we see. That's this green line that just appeared, and the prices are on the right-hand axis as you look at the graph here. So back in 2008, we had oil and gas prices really spike, and that was due to a really lack of basically excess demand. As the economy was really growing strong, we didn't have enough supply. The U.S. really helped to fill in a lot of that supply with our oil shale boom that we had, and that did help to kind of temper gas prices there a little bit as we reached equilibrium and then have since exceeded equilibrium. But when we look at 2014 and beyond, we really do see that excess supply on the market, over 1 million barrels of excess supply, and that has caused mining employment to fall, which in turn has also decreased the amount of oil that we're producing nationally too. Unfortunately, to kind of a question that was brought up, it's an international market that we see, and Iran is bringing a lot more oil on. OPEC is having trouble trying to agree how much oil they want to produce. Saudi Arabia doesn't want to be that swing producer that they have been in the past, and so there's really no one that's really willing to rein in their production, but it is kind of happening through the force of the market, where production through the United States oil producers is falling a little bit. We're down about 500,000 barrels from our peak, and probably can fall about that amount again, which will help us to get back to equilibrium, but it's kind of a guessing game as to when that's going to occur. As Jason mentioned, I was going to look at some of the regional changes here, and this is kind of just looking at a few of our metropolitan statistical areas that we have across the state. The first one I'm going to show you is the Greeley MSA, which is Weld County essentially. And Weld County was really a poster child for growth back in 2014. In fact, they were the fastest growing county in terms of the number of jobs that they added. They added more than 8% of workforce growth there in their total employment, and the driving force behind this was really the increase in oil and gas jobs. However, if we look at this chart from January of 2015, the over the year growth rate in Weld County has been on a steady downward trend. They were up over 8% at the beginning of 2015, carrying over a lot of that inertia that they had from 2014, but then that has greatly changed as the oil and gas industry has gone from being up about 15% on a year-over-year basis in January to down about 16% there in Weld County. And now Weld County has about 7% of all their jobs are tied to mining. If we contrast that to Grand Junction and the Grand Junction MSA, they have about 3% of all their jobs tied to mining, and we can see Grand Junction has kind of been flat. That's really their employment changes has been emblematic of a lot of what we've seen on the western slope, really kind of struggling to regain traction coming out of the Great Recession, and really not yet kind of back to that 2008 employment peak. And so I think we have Grand Junction as our only western MSA, but I think if you would take that and extrapolate it, you could see that kind of up and down the western slope as their performance might even be a little bit better than some of the other communities where there might be a little bit more mining influence, especially those communities in Delta and Moffat County, where they have more of a coal mining impact that has really pulled down their employment as well. Now, if we look at Denver, Denver has about 2% of its total employment in mining. A lot of the front office jobs are located in Denver, and you can see where Denver was growing at over 4%, and their growth rate has come down much closer to that of the states, as Jason mentioned, at about 2.5% on a year-over-year basis. Now, if we contrast this to a county or an MSA like Larimer County or Fort Collins, where there's not much oil and gas employment there, we see that they have actually done fairly well, and their economic and job performance has actually increased a little bit or maintained steady right around 4% there. Likewise with Colorado Springs, there's not as much of an influence there, and they've essentially kind of mirrored what the state has done. They were doing a little bit better than Denver has done there, but they're kind of neck and neck with Denver now, which is really quite an improvement for Colorado Springs. They were lagging Denver and the rest of the state, and now they're kind of at the same pace or a little bit faster than where the statewide average is there. So now I'm going to shift gears a little bit and kind of talk about what the forecast for oil and gas jobs look like nationally. This comes from Moody's Analytics. They put out a forecast that they update every month, so I pulled this at the beginning of April. And what they're showing is still continued losses throughout 2016, very similar to what Jason said, but they do show us kind of reaching a bottom, about another 11.5% decline in mining employment across the United States in 2016. That's just under 90,000 more jobs that we're going to lose, and unfortunately these are very high-paying jobs that have a very big multiplier, as Jason mentioned too, so that's going to have ripple effects throughout our economy. But they do kind of foresee oil prices bottoming out in 2016 in a very gradual recovery of our oil and gas and mining jobs. Kind of one of the assumptions that they have under here are about $40 per barrel on oil for average on the West Texas Intermediate in 2016. They are projecting that will go up to about 56 in 2017 and then 65 in 2018. Now that is a little bit more bullish than what the EIA has and then what Jason said, but they also do another forecast that's kind of their low oil forecast. And this is what they project would happen to mining jobs across the United States if oil prices remained in the low $30 range per barrel. They foresee that we wouldn't really reach a bottom until 2017. We'd still have a significant more amount of job losses that we're considering, that we would be experiencing throughout 2017 as well, and then just a slight uptick that's occurring in 2018. So to shift gears and take us over to our Colorado forecast, I have two different forecasts up here. The first one is done by our office. That's the red line, the Colorado Mining from the State Demography Office. And we show something very similar to what Jason is expecting. We are kind of expecting a bottoming out of employment right around in 2016 and then a gradual recovery. We did this forecast back in the summer when oil prices were a little bit higher than they are right now. And so I think, you know, our 2016 bottom is probably a little bit higher than where it is actually going to be. We'll probably bottom out more like what we see with that blue line there, which comes from the Colorado Department of Labor and Employment in the Labor Market Information Office. They do short-term and long-term projections, and these are their short-term projections. And the way these projections look are considerably more bearish than what our projections are. However, it bears in mind to look at when they produce these, and these were just produced back in February, and at that time oil was traded in the high 20s there, and we just got a lot of information in on how severe our job losses were in mining, and we basically, as Jason said, we're down about 7,000 jobs, about 20% in our mining employment, and what they're foreseeing is that if oil remained depressed on price and natural gas remains low, that we could see about 20% declines over the next couple of years. So I think that is a very pessimistic and negative outlook, but it bears in mind to show how much difference there is of opinions that are out there just among Colorado agencies. So the volatility in oil prices really does make it difficult to really pin down what future is going to hold and what the forecast is going to hold for us as well. Now, to get to a little bit more exciting outlook here, this is looking at our Colorado oil production by our top counties from 2008 to 2015. Now, this information comes from the Colorado Oil and Gas Conservation Commission. They are finalizing their 2015 numbers this month, so hopefully this number won't change very much, but very impressive, 127 million barrels of oil that were produced in Colorado. That's growth of 31.2 million barrels from what we had in 2014. To put that into context, if you look up there in 2009, we only produced 30 million barrels of oil in the entire state. in 2009. So our growth has just been exponential almost. And as you can see from this stats graph, Weld County is the big blue line on the bottom. All the other counties kind of run together. Rio Blanco's in the red. They are still producing about the same amount of oil, but their share of state production has declined considerably. Same to be said for Garfield. We can actually see a little bit less oil that's being produced out of Garfield County than back in 2012. One interesting thing of note is that Arapahoe County is actually coming up a little bit on this chart. There are over 1 million barrels that's being produced in Arapahoe, so that's kind of a little bit of that Denver-Julesburg basin play in the Niobrara as well. And now if we just look at Weld County alone, they increased their production by about 31.9 million barrels in 2014. So their production that they increased was more than what the state was. So there were some losses that occurred throughout the rest of the state in areas that are just not as geographically friendly for drilling, maybe not as close to some pipelines and distribution centers or to refineries there. So that kind of just is why there's been a little bit of the shift to Weld. Kind of to put it into percentage terms, back in 2008, Weld was responsible for just under 60% of all the oil that is produced in our state. And now if we leap forward to 2015, they're just under 90%. So 9 out of every 10 barrels that are coming out of Colorado are being produced in Weld County. Unfortunately, I don't think this exponential trend is going to continue. One of the reasons why is kind of what Jason cited, is that our number of oil and gas rigs that we have drilling is less than half of what it was last year and down by almost a quarter from the peak. So at 17 rigs drilling, we're just not going to get the same amount of production. But the drillers are really going after some really plentiful wells that they're getting. They're getting a lot of hogs that are producing a lot of barrels of oil per day, over 500 barrels of oil per day. So the drillers are being a lot more effective in where they're drilling, and when they're hitting, they're really getting good returns. They're just not drilling as much as they were in the past. Now, to take another perspective and look at natural gas production in Colorado has been essentially flat since 2011, but one of the things that we see that has occurred has been a big shift in where the production has been occurring. And we see the red line on here is Garfield County. Garfield County has always been the hotbed of natural gas production in our state here. But Garfield County really peaked in 2012. And since then, their production has been on a gradual decline. If we look at La Plata, which is in the green line, and Los Animas in the purple line, they've also kind of seen gradual declines over this period in time. Now, the only reason why our state-wide production hasn't fallen off at all is because of Weld County. And Weld County's production has increased considerably. Back in 2009, they only produced about 1/3 as much natural gas as what was produced here in Garfield County. But however, when we get to 2015, Weld County is producing about 4% more natural gas than what Garfield County has produced. And now I believe tomorrow afternoon we're going to hear from IHS. They're going to talk a little bit about this. But two things that are happening here in Weld that has caused their production to go up is what's known as associated gas, and a lot of gas that's coming up out of those oil and or the oil wells that they're drilling there. And they're doing a lot better of collecting that, a lot better job of collecting that gas. That really started back in 2012, and they've been collecting a lot more of that gas, getting it to market, not flaring it off. So that's very positive for Weld County, and has helped to keep our natural gas production fairly stable for the past 5 years here in Colorado. Unfortunately, as we've seen with Weld taking a bigger share of the oil production across the state, and also now the largest producer of natural gas, is it's really caused a shift in where our oil and gas employees live by county. And this is going to play into the direct distribution a little bit that Irv will address as well. But if we look at 2009, 53% of all oil and gas extraction employees, those are employees who are working more than 500 hours in the actual extraction industries and working in the fields, were on the western slope. That's Mesa in the red, Garfield in the green, and then we also pick up Los Animas in a lighter shade of red, and Rio Blanco as well. Now, if we flash forward to 2015, we see that the red and the green in Mesa and Garfield has made up a much smaller share of that pie overall, and a lot of those jobs in extraction have shifted over to the Front Range. So now we have Garfield, Mesa, and La Plata and Los Animas down about 30 percentage points. They're just under about a quarter of all extraction workers that are in the state. And then if we look at Weld County, Adams County, Larimer County, Denver County, and add all those together, they're over half of all of our extraction workers that we now have in the state. So that's really been a major shift that we've seen occurring with the extraction workers moving from the western slope and then now located in the Front Range. And one of the things that I mentioned earlier, a big theme that our state demography office likes to drive home, is that the population is really going to follow the jobs. This map is a thematic map that kind of tracks the population changes across counties from 2010 to 2014. Our office has not yet finalized our 2015 county estimates, so we will have this updated shortly. But the bigger picture I want you to get is just the trend that you see. If your county is in a shade of blue up here, you have less people living there than you had in 2010. Unfortunately, there are 27 counties on this map that are in a shade of blue. Now, if you're in a shade of orange or red, you have more people living in your county than you did in 2010, and that dark red is 10,000 more. If you look at where those dark red are concentrated, they are all concentrated along the Front Range, Larimer County, Weld County, down to El Paso County. So that's really where the population growth has occurred, because that's where most of the job growth has occurred, as I said at the beginning of the presentation as well. If we look at 2015, some of our preliminary numbers, there's still a lot of blue on from change from 14 to 15. We have about 16 counties that lost population. That's about a quarter of our state that is still seeing population declines. Now, mind you, if you look at this thematic map, a lot of that population decline is occurring on the eastern plains, but we're also seeing some of it on the western slope. And as Jason mentioned, as the unemployment rate rises in some counties out here, and as the jobs aren't as plentiful as they were 6-7 years ago, you're going to see the population move to where they have jobs. A lot of the people who are working in the oil and gas extraction industries are 25 to 45 years old. A lot of them have families to support, and they can only hold out so long on severance packages or unemployment packages, and then they need to find another job to provide for their families. So real quickly, in summary, as Jason mentioned, our diversity of our Colorado economy has helped us to weather the storm and the downturn in oil and gas prices much better than we did 30 years ago. However, our growth has been really divergent across the state. The Front Range has done a great job and has really been the engine of growth for the entire state, and a lot of the other parts of the state, the western slope, has kind of felt like the recovery has passed them by, unfortunately. Oil production is up in 15 despite prices being depressed and industry employment falling. I do think that we are going to see oil production fall in 2016. Just kind of some preliminary numbers from looking at January. It kind of looks like oil production is down about 8%. In some forecasts that I've seen, have kind of been about around 8 to 10% range in oil production decline. So I'm hopeful we'll still produce over 100 million barrels of oil in 2016. But a lot of that's going to be dependent on the market and forces that are out of our control largely. The Denver-Julesburg Basin has really benefited, and employment has shifted there, and that's come at the expense of the western slope, unfortunately, and the population has followed as well. And so one of the risks that we see is employment losses could lead to continued population declines in a lot of our resource-dependent economies, unless a lot of these economies and a lot of these counties out here can continue to work upon diversifying their economic base. And I know that's something that's really been a focus of the governor in his second term, is really giving a lot of help to rural communities. The Office of Economic Development and International Trade has a strong focus on helping a lot of these more rural communities, help to look at identifying new industries that they can bring in and help to expand their base to be less dependent on extraction industries and to have a more vibrant and robust and diverse economy that more is resembling the rest of Colorado on the whole. So with that, I'm going to turn it over to Herb for the last couple of minutes here, and then we'll take up questions together after Herb's presentation.